Peter, I'm promoting you now so that we could talk. Not sure what, there we go. Welcome back to F.A.C.E, Peter. What a day to be here. How are you?
Can you hear me okay, Dale?
Got you now, Peter. How are you?
Okay, good. Sorry.
All right.
Yeah.
All right. What a day. You want to hit the green share screen?
Absolutely. Yeah, let's do
we
that.
Get going.
Let's do that.
Yeah, so ruble new all-time high at one point today, wasn't it? All right, let's start here. So well, I remember this NASDAQ, right? Yeah, so I remember your report in December about January, and you were looking for a correction. And then when we got to that low in a few weeks ago that everyone thought might be a bottom, you were calling that the end of that was 3, and then we had a 4 bounce, and now we're down. Is this 5, or we're just going to continue to wash out here?
Well, I think we probably are looking at some sort of 5-wave generic move down. I was just working some mathematical measurements here.
Yeah.
And seeing what prospect we had for later today and tomorrow. And overall, it does look as if we've got a generic 5-wave pattern downwards. I mean, there is some sort of unconventionality with this, because the 3rd wave for the NASDAQ looks as if it's subdivided into 3 waves, which is a bit of a red herring, if you understand that as a meaning for, a bit of a...
Yeah, 3 was 3 instead of 5.
Yeah, I mean, I've seen something like this, but inverted on an uptrend back in 1999, when the NASDAQ was actually in its last phase. It was within about 3 months of reaching the .com peak in early 2000. And the last 5-wave sequence up in the NASDAQ during that 99 advance was a conventional, what we call an expanding impulse pattern, where you get commonly, one of the waves, typically 3, expanding the price range. But the subdivisions in those impulse waves were 3s. And it, in a way, looks like that here. You've got a 3 swing down in wave 1, a 3 swing down in 3, and even a compilation of a 3 price swing, what we call a double zigzag in here. And it's a bit unusual, to be honest. If you look at the overall form without actually taking any notice of the subdivisions, then sure enough, you've got 1, 2, 3, no overlap in 4. And the 5th wave measurements are coming into completion at the moment.
Yeah.
So if you just take the generic form, it's okay. But I'm quite intrigued by the fact that it's folded and subdivided these impulse waves into 3s. That's very unusual, to be honest.
So could there be a possibility that this whole thing is going to end up being corrective, and the bull market continues in the face of the Fed and geo risk? What's your take? I know you just take it a day at a time, but would you be looking for getting long for a trade in the S&Ps or Dow or NASDAQ, any of them, in the coming days?
Yeah, I think we could probe a long positioning within the next couple of days or so.
Okay.
I think that we've got a little bit left to do on the downside here on the NASDAQ. And another good example, I mean, the S&P, ironically, and the Dow are not great examples for getting archetypal patterns out of the analysis at the moment, but one that's actually quite good, ironically, happens to be it's the Russell.
Okay.
The
weak sister for here. Yeah.
That's right. And if you take a look at the Russell, you can see that going back to that November high here, we've got another 5-wave sequence, except that this one is still about 4 or 5% off its low. That's a little bit worrying, because there's no obvious way that we could buy this at the moment. And if this is going to drop 4 or 5%, well, I mean, it could exaggerate to the downside and underperform. So that means, 2-3% down on the NASDAQ. That's possible. That is certainly possible. But this tells us not to be buying today.
What about a fifth wave failure on the Russell here?
Well, that would be okay if we could see a substructure in wave 5 here.
Yeah.
But at the moment, it's an incomplete sequence down. It's not. There's no visible 5-wave completion there. So it doesn't really evoke the idea that we could see a truncation or a stunted fifth wave. It's looking a little bit incomplete. So I know that there are quite a few divergences, aren't there? On an RSI, for example, if you pulled that up, you would see some divergence. Typically, we see that between the third and the fifth waves. But it just doesn't look quite ready, does it? Basis this Russell, it looks like it needs a little bit more to the downside.
Well, I think a lot of people are focused on Russia-centric markets, which of course means crude, precious metals. And I know you were looking for a new high in the dollar, new low in euro, which it looks like we're on our way to that. And I don't think you were expecting new historical highs in the ruble, but it's leaving quite a tail today. But the gold move was spectacular. I mean, can you buy gold just to chase it? And I felt like that $100 ago.
Yeah, I mean, I must admit that I thought the gold might have pulled back first. I mean, it's been a rather sort of defragmented sort of advance on gold in this latest run. But I have to admit that I was wrong in the very short term there. I thought that we would get some sort of pullback before this next push up. But looking at it, it looks like it's already running. And that means a revisit back to sort of I think back to the 2080 high up here. This is how I think it's probably going to look now. I was hoping it would pull back and stay below 1877 originally, but this thing's far too powerful. And I think, it looks like it's going. The thing is that silver should outperform. It's been a lagging in the last couple of weeks, and it's only really this week that it's starting to get some momentum going. So silver, I think, is probably better to buy than gold, because gold's pattern up from these lows is very fragmented and very overlapping. It's not great. But silver, you've got a fairly clean, concise movement. Now that silver's broken today, sort of above some key resistance levels. And I think that's leaving behind this overall correction and starting to trend up. So that means, we could be looking at $37. That was the original idea anyway. So I think if I wanted exposure in precious metals, I'd prefer to buy silver.
Okay, 2050 off the table.
I don't think we can expect that now, because we've broken this 2478 number. And even today, I think this 2545 is even more important. So I don't think we can expect 2060 anymore. I think today was a critical day today to show that this thing is already in its transient next move up.
Okay. All right. And oil? What kind of count could you have in oil with this blow off today?
Yeah.
You have a revised count on it?
Let's have a look at Brent, because it's 3101. I was looking at this early this morning. This is Brent oil. This is the move up from December. See, the thing is that Brent oil and crude oil, they're unlikely to, they have the same rhythm as the 10-year Treasury yield. And we've got some pretty good forecasts on 10-year Treasuries, 5 years, 30 years. They all look as if they've topped out last week. And they're starting a new trend to the downside. Now, of course, that tells us that dollar yen shouldn't be too far behind turning down. It also tells us that oil shouldn't be too far behind turning down, because oil is basically the inflation trade, really. If you want to trade on rising inflation pressures, you buy crude oil, or you buy one of the energy markets. If you think that inflation pressures will pause at some point, you've got to be thinking about where oil is going to top out. So the last time that 10-year treasuries moved up was December. We were at 170 then. And this has moved up since to 206%. And we've got here Brent oil moving up in a 5-wave pattern. Now I've applied a 60-1/8 correlation ratio. That's 1 to 3 times 60-1/8 equals 5. And it produces this 103 number, 102.92. So I'm quite keen to see how that gets on today, because I think if that tops out, then we're definitely starting to look at a major peak here. And that means calling the entire 5-wave advance from the pandemic lows as approaching this completion. So I can't see why oil in any way or form would be continuing this same velocity to the upside. I don't see why it would do that.
Okay. So since the Dixie, what are we, a stone's throw away from some of the targets you had in Dixie and Euro, and seems like Aussie's been more resilient, but it's under pressure here. So do you think that maybe this last push up in the dollar might create some type of pullback in the metals, or it doesn't matter? They're both going up together. And,
well, I mean, the dollar
ahead.
should be finishing its sequence. This should be the last sequence of all. I mean, the noticeable thing here was that this time last year, we had upside targets to about 95.80. That was originally the 50% retracement of the pandemic downswing from 102.99 to 89.21. And this was always considered to be a corrective pattern, which it is, except that the final fifth leg of this wave C of the secondary zigzag goes back to September here, 91.95. Mm-hmm. I mean, that's evolving in 5 waves, and the fifth wave from January's low should have unfolded to a higher high in 5 waves, and we only detected 3 at the time. So when that sharp drop occurred late January, early February, we then started to work with this diagonal pattern, because 3 waves up cannot complete this sequence. It has to be a 5-wave subdivision. Well, we can augment a 5-wave subdivision if this is a diagonal. And that would certainly comply with the idea that this is a zigzag for the first wave of that ending type diagonal. So, and sure enough, the dollar's pushing up. So there's no doubt in my mind that once we get up to 98 in this sequence, and it might take another couple of weeks or more, because we've got to have a 4th wave pullback at some point, maybe in 2 or 3 weeks, that this will be finishing. But there's a bit of a disconnect, isn't there, in terms of amplitude with these, because, okay, we've got gold and oil now breaking overhead resistance. So they're trending up whilst the dollar's pushing up. Whereas before, the main driver for gold and silver was really sort of what the dollar was doing. If it was moving up, gold and silver would edge lower. If the dollar was in a correction, then it would give a boost for the precious metals. But that's be completely disengaged now. So it looks like if this dollar is going to head up and finish 98 figure or thereabouts within the next few weeks, and then starts a massive decline, which I think it will have to, then that's going to be an even bigger boost for precious metals on the upside. And I don't think it necessarily means I don't think it necessarily means that is good for things like copper or some of the base metals, because they look very top heavy already. I think they're on their way down, actually.
Or oil?
Yeah, I think oil you see as an inflation trade. So if we're going to predict stock markets continuing lower over the next months, which is what we originally had at the beginning of this year, right, and you get that's going to cause inflation pressures, then you're also going to see oil drop, aren't you? Because that's the inflation trade at the moment. So that oil price will have to come lower if bond yields are going down, if stock markets are going down. At some stage, that disconnect will have to change, and you're going to have to see oil go down on the basis that we're seeing a bit of a contraction in the growth of the economies around the world.
Okay, Yeah, so really it's almost like the markets have become, was all one market. And you're right, it was dollar centric, and we've decoupled from this. I'm wondering with your forecast on yields, and it was a great one, got up to there and turned, I don't know, maybe there's another push. I'm wondering, while the Fed, your forecast is basically saying we could pull back in the 10-year to, okay, there it is,
Yeah.
while the Fed's in a hiking cycle. I just have a hard time understanding. All right, so the market already has priced in everything the Fed's going to do, and yields are going to be cut in half while they're hiking, or are they going to pause because of the geo risk in the markets and things? Are they going to flip the switch and hold off?
Yeah, I don't think. I think that probably. I always thought that they were going to front load by 50 basis points even before the market talked about that. I just realized that the Fed were panicking, and that they might even front load, and that's come into the mainstream discussion at the moment. Obviously, yeah. If
so
yields
you wait for the Fed in mid-March and then buy bonds.
Well, I think I've already got all of our clients, about 50% of our client book is actually trading fixed income yields, and we're long T-notes and bunds in a big way, actually. Quite committed to that, the clients, and I think the outlooks look really great. I think the narrative has got to change. I mean, I know the focus is on Russia, Ukraine at the moment, but I think the narrative has to go back to Fed tightening at some point. That's going to be bearish for stock markets anyway. That's basically going to mean that we're going to start thinking about commodity prices coming down, a pause in the inflation pop. So inflation pressures start to ease off. And I think generically, yields will start to turn down because the economy is going to contract a little bit. So I think the narrative is going to switch around a bit. I mean, let's face it this way. If you've got a war in Europe, which there is now, wouldn't you think these yields would be declining far faster than they actually are? I would have thought so.
Yeah, if central banks had not started the narrative, and not only the narrative, acting on it. Didn't the Royal Bank of New Zealand raise rates, or was it Australia this week, and BOE a couple times already?
Yeah.
So we're already in. If we weren't in that cycle, I could see this chart, but it's almost a Rod Serling correlation.
Yeah,
it's a Twilight Zone correlation now.
It is, and I just when I look at this, I'm thinking, okay, yeah, we've got Russia, Ukraine at the moment, but I think the narrative, I think the bond markets are looking at that and they're saying, well, we can't buy T-notes and T-bonds at the moment in big size. I don't think the market's generally aware that there's a turn down around, which I'm depicting here, that this entire movement up from the pandemic low is a 3-wave zigzag, and this 5-wave advance from the August 20 low is finishing. I don't think the market's not aware of that. What they're thinking about is still tightening. So in that context, they're not even buying bonds because of the war situation on a safe haven basis. I think ultimately, if the Fed go ahead and hike 50 basis points, it wouldn't surprise me at all. Then they suddenly back off and say, well, we're going to review things. That is a bit forward thinking. That's giving a lot of credibility to the Fed, and I don't give them much because I think they're so behind in their projections forward out that they could look at yesterday's paper and never get it right. So I just don't think that they're probably going to say that, but I think the market will adjust in time. I think we're going to see a pause in the inflation pop, and I can't see why oil would hold up for too long in that environment either.
Part of this could be also risk off, because I know you have lower targets for this huge wave 4 correction. If you want to share your longer view on S&Ps, perhaps that's also the catalyst for yields to come in.
Well, that's it, because originally the
In fact, that's
idea.
what you told me. You said what we had a talk, and you go, well, what else could bring rates down? And that's before the market topped. And so you were saying if your interest rate um, scenario was correct, that it most likely meant a risk-off move in equities. That was well before Russia came on the scene.
Yeah. No, absolutely. And the reason behind that is this is the S&P daily chart from the pandemic low. And I've always maintained that this is a 3 price swing event. And if it is, we can try and prove that. If we extend this by 61.8, here's the projection where the C wave should end. And it started here at 3,200. So that deviation is negligible. So that's good enough proof that we've got what's called a zigzag in Elliott wave terminology. This zigzag, this 3 price swing event, and the only way that can begin a new uptrend, a zigzag, is if it's part of a diagonal, which is this idea, where the diagonal is a sort of a wedge-shaped 5-wave pattern, 1, 2, 3, 4, 5, and of course, in order to get the wedge shape correct, because this is the component wave, atypical of an ending type diagonal. This is the 5th wave, so it's ending the trend, which began back here from the financial crisis lows. And that is as a standard prerequisite, you need a 76% adjustment to the downside. And that's why we've got this huge downside target for this year. And we've been basically talking about that for several months.
Yeah, check out Peter's video. Also, at the beginning, it looks like you were looking for a rally maybe back towards 4,700. Is that off the table before the next big decline? Or are we in that spot now at this 4,100 level that we get that bear market rally before another big break instead of people just chasing gamma and whatever they're doing, these new Greek words that, specialists are doing. Perhaps there's going to be a much better level to sell at than down here.
Well, I was previously thinking that we had a chance of a nice sort of 6-7% rally, but I'm not sure that we're going to get it now that we've added to the declines today. I think we might still get 4-5%, but not maybe 6-7. And I showed you at the beginning today the Russell and the NASDAQ chart under the microscope. I think the picture here, let me see. Yeah, I mean, I think we have got a 5-wave pattern if we're going to replicate the NASDAQ down. So we're going to get some sort of rally. But I was taking a look at the one joker that's basically pulled out of the pack that doesn't really make sense much for a rally of more than 5% is really the DAX. You see here in Germany, the Xetra DAX, I mean, the pattern looks really bad. I mean, it looks very bearish. And I'm not sure we're going to get more than 4 or 5% out of that. The way its construct is working. So I think 5% is probably about what we should be hoping for if we can get another selling point before we come down again. But the DAX is really, it doesn't really look great. And because of that, we're sort of paring down the Russell sort of like rally after we get down here. If we can get down here in the next day or two. I think the rally normally in Elliott wave, you would return back to wave 4 preceding, which in this case would be about a 50% retracement, if I'm not mistaken. Let's just measure it down here. Yeah, 50%. But you see, the problem with that is that that's too big a percentage move. I think it's probably only going to do 38%, which is a sort of a basic minimum requirement, which is somewhere up here, 2020. But even that is, that if it moves up from 1790 to 2020, where are we doing about 1790%? That's 12%. Even that's quite big relative to what the DAX can do. So I'm not sure it's going to be doing something like that. It's a bit tricky at the moment to evaluate that, but well,
tricky is a great word. I mean, look, we haven't experienced anything like this for, I don't know, 80 years. So, only our dads remember what it was like to trade.
That's a little bit of an exaggeration, I think. Dale.
80 years? Okay, well, I think
no, I mean,
turned out to
you can't compare what happened 80 years ago to what is happening, at least for the time being.
Not
right?
yet. You know, I mean, look, the Sudeten land was all Hitler wanted. I rest my case.
Hi, Peter, by the way.
Okay. Anyway, so Peter, great stuff. I really appreciate on a high stress day where I know, you know, a lot of people are depending upon you, your subscribers, that you took the time out to come and talk to us.
No, thanks, Dale.
I know it's not, I know what it's like to have heat and, you know, markets that are, you know, exponentially like 8.0 Richter scale stuff happening in the markets. So really appreciate you being able to have the composure to do an interview with me today.
No, thanks,
and
Dale.
for our
Thanks.
community.
Thank you very much. And I just
go ahead.
Yeah, I was just going to say that yeah, anybody listening in, just be safe, be careful. I mean, watch out for these numbers. Don't overstretch, you know. And if at all, and you're not sure, don't trade. Yeah. We're trying to piece together things as much as we can. And you know, we'll be publishing our report tomorrow night. Hopefully, we'll have something concrete to show everybody.
How do they reach you, Peter?
Yeah, as always, you can go on to have a look at wavetrack.com. Thanks for that. This is wavetrack.com. Just go here.
Oh, look, you're a subscriber.
I
see your name in there. You must subscribe to the service.
Where's my name? Peter. Oh, here. This is my password. Yeah. Yeah.
Anyway,
I find it quite useful.
I'm glad you subscribed to your service.
Yeah, anyway. No, good. Yeah, I do. Yeah, who wouldn't eat their own food if you're a chef? Yeah. And okay, and you can click on subscriptions, and if anybody wants to tune in, we'll be publishing another update tomorrow night, the Elliott Wave Compass, and you can just click on here and add to and go through the subscription thing. So yeah, thanks very much. You know, that would be great. We'll get there. I think we'll have something concise pulled together. We're working on it through today. We've been up all night. We've had 4 hours sleep in 24. Yeah. We're committed to try and find the answers for everybody. So stay tuned.
All right, Peter. Thank you, my trading warrior. Thank you, my trading warrior brother.
Thanks. And nice to hear your voice, Steve.
Yeah, nice to hear you as always, mate.
Great interview, Laura.
Okay.
You're welcome.
All the best.
All right. Adios. We'll see everyone tomorrow. Remember, don't just count your pips, your blessings, and on fire. Everything being different ways. Join the team and Clean Edge, and we'll see everyone tomorrow. Hope for peace. Thank you, Paul.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.